Good evening, everybody. So welcome to this presentation on as part of our EIS series. So this session is basically talking about the exceptions to the 7-year age limit for a company under EIS. So if you've attended our previous presentations, we've done a couple of different topics so far, and then we have another one, a final one in this series, which is in a month's time, and that's really focused on EIS for investors. So this is very much looking at it from the perspective of the startup, so from the company's perspective. Before we start though, a bit about us as a firm. So we are one of the only firms in the market who work exclusively with startups. So most of our sort of competitive firms, they do bits of startup stuff and then bits of other stuff as well. For us, working with startups is everything that we do. Startups is a relatively loose term in practice. So for us, it's everything from literally pre-incorporation, so working with founders before they incorporate, all the way through to exit. But the sweet spot for us, if you like, is that sort of later stage investment, so Series A, Series B onwards. Most of our clients tend to exit around about sort of Series A, Series B, valuations sort of between about 50 and 200 million. So that tends to be sort of where most of our clients sit, obviously with lots of people on the smaller end and a couple on the bigger end as well. A big part of what we do is raising investment, and London being London, there's an awful lot of angel investment going on. So EIS is something that we spend far too much of our lives thinking about and worrying about. So just to introduce me and my colleague here, Ellie. So I originally used to be on the dark side of law, so I worked for 2 big New York law firms. Did that for 9-10 years, and then set up Buckworths in 2011. I've advised probably more startups than I care to think about, to be honest, but you know, more than 1,600 startups in the last decade or so across a range of sectors. As a firm, we tend to be known most for tech and fintech, but we also have a big hospitality group, and we have clients in a range of other sectors as well. I'm an entrepreneur in residence at a bunch of universities, including LSB and UCL, which basically means I'm involved in advising startups on their sort of entrepreneurship scheme. And most excitingly, a couple of years ago, I wrote the best book ever written, obviously, called Built on Rock, which is basically a sort of a guide from the legal perspective of the things that founders need to think about as they go ahead with setting up a startup. So that in a nutshell is me. Ellie, tell us about yourself.
Hi, yeah, so I'm Ellie. I'm an associate here at Buckworths. I started over 3 years ago now with Buckworths, just as a young paralegal, and trained and qualified last year. So throughout my time here, I spent most of my time working on angel or VC investment rounds, which means that a lot of my day-to-day has been looking at EIS, other sort of tax reliefs like SEIS. So I've also had my fair share of experience in sort of startups and angel VC investment rounds.
Cool. So in terms of what we're going to cover, we're going to start just by introducing and just recapping on the age requirement for EIS. So EIS, as we talked about in previous seminars, there's a lot of conditions to it. There's a lot of things that you have to comply with. One of the most important things is you have to be within the permitted age to raise under the scheme. So we'll start off and just recap on that. And then we're going to talk about the 3 ways that effectively you can extend your ability to raise investment once you've gone beyond that sort of initial period. And the 3 things are what we call condition A, which relates to what's called follow-on funding. Condition B, which relates to entering a new geographical market or launching a new product or service range. And then the 3rd thing is knowledge-intensive companies. So we'll go through each of those 3 things in order. So to start at the beginning, it's a bit of a recap. All of the tax relief schemes, so the venture capital schemes, impose an age condition for the companies that can use them to raise investment. So SEIS, which is the sort of the baby scheme, if you like, companies can raise up to £250,000 under that scheme. And they can do it for 3 years from the point that they have commenced trading. So SEIS, 3 years after commencement of trade. EIS that we're talking about today, that is 7 years from commencement of trade. So what do we mean by commencement of trade? For most businesses, this will be the date on which they first sent an invoice. So the date that they first generated revenue. It is possible for commencement of trade to actually be an earlier date than that. So it could be the date that you first opened for business. So if you think about, I don't know, a restaurant on the high street, the restaurant's been fitted out, you've got all your kitchen equipment in place, you've hired your staff, you've got your food ready. When you open your front doors and you allow customers to come into the restaurant, that is the date potentially that you can say that you've started to trade. Doesn't actually matter if nobody comes into your restaurant for a week, you can still use that date when you first open the doors. So that's the sort of the standard definition of commencement of trade. There are two circumstances that it's just worth flagging that can change that very slightly. So the first situation is where you started your business before you incorporated the company. So sometimes what happens is the founders may have started their business as a sole trader. So if you go back to my restaurant example, they started out as a sole trader. Perhaps they had a market stand in Borough Market. They were selling food to people, sort of testing the idea, testing the product, seeing if it works. They then later incorporated and set up their company. So in that case, commencement of trade would be the date that they started the business as a sole trader. So it's going to be before the date that the company raising the EIS investment was incorporated. So that's the first sort of weird point that can arise. The second thing that can cause complications is where the company raising EIS has acquired another business. So if you acquire another business and that business's commencement of trade date is earlier than yours, then their earlier commencement of trade date is imputed to your company. So you might be a company that's got a commencement of trade date, say 5 years. So you started trading 5 years ago. If you go and acquire a business that's commencement of trade date was 8 years ago, well, then your commencement of trade date for EIS purposes is now 8 years. And the problem there would be that you'd be outside of that 7-year permitted period. Final point, just before we move on to the ways to extend the period, is just knowledge-intensive companies, which Ellie's going to talk about in depth during this presentation. But the really important point here is that for knowledge-intensive companies, the initial investing period for EIS is not the standard 7 years, it's actually a longer 10 years. So, Ellie, do you want to tell us about Condition A, follow-on funding?
Yeah, so this is the first of sort of the exceptions to the rule that we're going to talk about today. So if your company has raised their first sort of risk finance investment in that initial investing period. So basically what that means is if you have submitted an SEIS1 or an EIS1 compliance statement to HMRC to claim the relief in that first sort of 7 years, then you might be eligible to continue to claim EIS on your investments outside of that 7 years, so after that 7-year period. And that's what we call Condition A, and HMRC refers to it as follow-on funding. So there are a couple of rules around this. And so just basically what they are is that if you are going to do that, then the funding that you raise outside of your initial investing period must be used for the same qualifying business activity as the initial investment. So when you first claim that SEIS or EIS relief, you will have submitted an SEIS or an EIS1 to HMRC. Within that application, there's a specific point where you sort of talk about the qualifying business activity of your company, you sort of explain what you do. So if you are then trying to raise investment outside of the initial investing period and you're going to submit the same sort of form, HMRC is going to expect to see the same qualifying business activity on both. The second is that the need for follow-on funding must have been foreseen in your business plan at that first initial investment. So with that application that you sent the initial time to HMRC, you have to have sent accompanying documentation. Something in that is the business plan. And so, yeah, they will expect to see that you have included the need for follow-on funding in that. Excuse me. So those are the two sort of specific ones for Condition A. On top of that, you still need to comply with all of the other conditions imposed by HMRC to be EIS eligible. If you've joined us for the rest of the webinar series, you'll probably be aware of these by now, but if not, go back and watch those. But very briefly, so you still need to continue to comply with the risk to capital condition, the growth and development requirement, two, which we emphasized last webinar, were very, very important. And also, quite specifically to this one, the financial health requirement. So when you're just a normal company claiming EIS relief, you still need to comply with the financial health requirement. And there's a test there which basically says that you have to be able to pay your debts as they fall due. So if you get an invoice, you've got to be able to pay it. And the second is that your liabilities must be less than the value of your assets. So that's the basic sort of test. As a company raising investment outside of the initial investing period, there's a separate part to that test, so a sort of third limb. And what it says is that your accumulated losses cannot be more than half of your issued share capital. So yeah, it's something to think about. You've got to think about all of those. You've got to comply with all of those conditions. So what's really sort of worth noting is that if you claim sort of SEIS back in the day, and you now think, oh, I need to claim EIS, that's okay. So it doesn't need to be the same scheme to use follow-on funding. So for example, if you're a company that was sort of incorporated and you started to trade in 2015 and you raised 150,000 and you claimed SEIS on that, and then since then you've been sort of developing your product and now you want to claim EIS on your next investment, you can do that. That would be fine, as long as you sort of comply with the rest of the criteria of this. So if you've sort of changed your business activity, for example, then you wouldn't be able to. So it's important to note that sort of, I keep saying, it needs to be exactly the same qualifying business activity, and that's true, but there is a slight caveat. So if sort of part of that business activity from your initial application has failed and you've sort of decided to put that to the side and you're continuing to develop with your the rest of the activity, that's okay. As long as it's still focusing on the same thing as your initial investment as you were then. So if you do see yourself raising investment, claiming SEIS, claiming EIS, and you think in the future you would definitely need to continue to raise, we cannot stress enough, make sure that you've got it in your business plan from day one, because HMRC will expect to see it. Now, that's not me saying that HMRC will expect to see, how much you're going to raise, exactly what dates you're going to raise. That's, super explicit and not something you'd be expected to know necessarily. But, for example, if you wanted to say that, you expect you're going to need at least 3 more fundraising rounds to develop your product this way, that's what HMRC are basically expecting to see. Now, if you haven't done that, maybe you're far into your sort of investment period now and you haven't included it in your business plans, you wouldn't qualify for condition A, unfortunately. But you may qualify under condition B, and Mike's going to talk to us a little bit about that now.
So condition B is basically, it's got sort of 2 options to it. So the first option is that you are launching a new product or a new service. And the second option is that you're launching into a new geographical market. So there's a couple of sort of important things to think about. The first thing is that the newness, if you like, must be material. It can't just be an incremental development. So if we think about launching a new product or service, it must be a significant new product requiring significant new investment, probably a load of research and development, a load of market testing, a load of marketing. So this is a big project requiring a significant amount of investment and resulting in the investors taking a significant risk. So it must be significantly new or a significantly new geographical market and not something that is just incremental. That actually leads on to the point about the risk to capital condition. So just as with condition A, which Ellie was just talking about, all of the standard rules of EIS have to be complied with. And the most important one here is the risk to capital condition. So in other words, investors must be making a highly risky investment. And if you're not doing something that is dramatically new, or you're not launching into a completely new geographical market, then you're not going to meet the risk to capital condition. You're not going to qualify under condition B. Timing is crucially important here. The investment that's being made on which you're relying on condition B must be made before the company takes steps into the new market or takes steps to develop the new product. So the logic here is if you've already tested a new market, you've already done your sort of exploratory work, maybe you've actually sold some products in that market to see if there's an appetite for it. What you've done by doing that is generated a whole bunch of data that allows investors to take a view on whether this will be successful or not. And as a result, the investment is not risky enough, the risk to capital condition isn't met. So you need to make sure that you raise the money before you properly investigate the new geographical market. Exactly the same principle, by the way, applies with new products. If you tested the product, you've done a bunch of R&D, you've tried it out with customers, you're not going to fall under condition B. So really think about if the timing of when you do this. If you think you want to fall under condition B, don't do exploratory work because it's potentially going to void your ability to use this condition. When HMRC are looking at this, there's obviously a bit of a grey area, right? If you are selling shampoos and your target market is the UK and Europe, it may well be that inadvertently you've had some customers say in the US, they may have bought from a UK site and had it shipped, or perhaps somebody bought a load of stuff from you and then tried to resell it in the US. That won't necessarily mean you can't rely on condition B, but the kind of things that HMRC are looking at and that you would have to explain to them are what level of activity has taken place in the jurisdiction you're launching into. How much time have you spent exploring the activity? How much money have you spent in exploring it? The answer on all three of those factors needs to be it's completely de minimis, so nothing dramatic at all. Whatever else we sort of talked about above, there are two things that must always be met, and these are really quite technical, so it's often black and white whether you meet them or not. The first one is that the amount of investment that you are raising in the investment rounds under condition B must be at least 50% of the company's average turnover over the previous 5 years. So you need to do the maths on this. What HMRC are trying to get at is, again, this point about the new thing being significant and material, not just incremental. So they don't want to see you relying on condition B and raising 50 grand. And so this condition is designed to stop you doing that. And then the second point, and something that really catches people out because they don't twig to it, every single penny of the investment money that you raise from investors who are claiming EIS, when under condition B, every single penny of it must be used on launching the new product or launching into the new market. If you use any of that money to maintain the operations of your current business in your current market or with your current products, you void the EIS on that money. So everything must be used for the new product and new market. If you need to raise money for the existing business, then that's going to have to be non-EIS money. So that's condition A and condition B. There's a third way to sort of extend a period of time, and that's a knowledge intensive company. So Ellie, do you want to tell us about these?
So basically, a knowledge-intensive company is going to be a company that's carrying out sort of, extensive research and development. And HMRC imposes sort of a couple of conditions on a company in order to be knowledge-intensive. So they're set out on the slides here. The first one, the operating cost condition, is a must. So you must meet that condition. There's a couple of ways that you can, which I'm going to talk about in a moment. And then the second condition is either the innovation condition or the skilled employee condition. So you've got a sort of bit of leeway on that one. So looking first at the operating cost condition, which, as I said, is a necessity, you must meet this to be knowledge intensive. What that says is that a company must have spent at least 15% of its relevant operating costs on research, development, and innovation in at least one of the 3 years preceding the investment raise. Now, that's one part of it. The alternative is that your company can have spent at least 10% of your relevant operating costs on research and development and innovation in each of those 3 years. So, as I say, it's either or. Now, you might be thinking that, I'm a startup, I haven't been trading for 3 years. Does that automatically mean that HMRC says I can't be knowledge intensive? That's not the case. If you are a startup and you've been trading for 2.5 years and you are going down the knowledge intensive route, then the sort of test is flipped on itself, basically. So it's actually going to be in the 3 years succeeding the investment. So it's still the 15% in one of the three or 10% in each of the three, but it's for the 3 years succeeding. So if you do want to sort of rely on that, that after those 3 years, what you'll have to do is submit to HMRC your, accounts and sort of maybe an accompanying schedule or other information to prove that you've met that operating cost condition. So sort of just as a top tip, if you are going to do it sort of succeeding, then make sure your accountants explicitly include research, development, and innovation expenditure on your accounts, so it's super, super clear to HMRC where that money has gone. So then the first of the sort of optional conditions is the innovation condition. And so what that says is a company must be engaged must be working to create intellectual property, and it's reasonable to believe that in 10 years, that company's business activity will be exploiting that IP or using that IP or both. So that's the first sort of optional condition. The second is the skilled employee condition. And what that says is at the time of the investment, and crucially for the following 3 years, at least 20% of your full-time employee equivalents must be skilled employees. And so HMRC, again, have a test to acknowledge who is a skilled employee. And so the test is in 3 parts. So they must be directly engaged in the research, development, and innovation activities of the company. They must hold a master's degree or higher. And this is also really important, the third part, because most people either ignore it or don't know or don't realize. Their job must require them to have that level of a qualification. So they must be required to have a master's degree. So it can't be just that they hold one, but that it's, you know, a job that anyone can do. So in terms of sort of the innovation in the skilled employees condition, you know, it is sort of an either or. But in terms of, for example, skilled employees, you have to be looking at the 3 years, you know, succeeding that investment, because you need to be sure that you can still meet it. Obviously, there are loads of issues that can sort of come into play here, because you may have levers, you may have, I don't know, redundancies or something whereby that 20% is reduced. So it certainly is quite risky. So you need to really look at that. So if you do qualify as a knowledge intensive company, that's great. And HMRC actually imposes higher thresholds in terms of sort of EIS raising and times to raise. So it is great if you can, if you're going to meet those thresholds. So these are sort of set out briefly on the slide. If you remember in our previous webinars where we've been talking about the sort of ordinary EIS companies, there's got a sort of few comparisons here in terms of knowledge intensive. So for knowledge intensive, you can have up to 500 employees, whereas normal EIS company, you can have up to 250. As a knowledge intensive company, you can raise up to 20 million in your lifetime and 10 million per year. But as a normal EIS company, you can raise 12 million in your lifetime and 5 million per year. And then most crucially, given it's what we're talking about today in this webinar, you know, the basic age limit is extended to 10 years for a knowledge intensive company. So that 10-year period is actually commenced from either the first date of sale, as it is with an ordinary EIS company, or the date that you first reached 200,000 revenue per annum. Now, that is actually up to you. So it's up to you to determine what's your commencement of investing period date. If you tell HMRC, you know, we're a knowledge intensive company, this is our commencement of trade date, you can't then later choose to change it to the 200,000 date. So it needs to be chosen. However, if you are an EIS company and you have your commencement of trade date as the first commercial sale, and then you become knowledge intensive, it's sort of up to you then which one you choose.
So I think to sort of bring all that together, there's always a question that comes up around which is the best condition and which one should I use to extend the period. And the answer is often that it depends on what you fall into. So very few clients come to us qualifying for all 3. It's pretty rare that they qualify for more than one, to be honest. I think that the crucial thing to think about with condition A and condition B is that business in distress point, that third limb. So to recap, if you have spent more than 50% of your paid up share capital, so effectively if you've got accumulated losses more than 50% of what's been invested in the company, then you're deemed to be a business in distress once you're older than 7 years old for a standard company or older than 10 years old for a knowledge intensive company. So if you're a standard EIS company and you've spent more than 50% of the amount being invested, you're not going to qualify for condition A or condition B anyway. So you're out of that, full stop. For you, you would have to be looking at knowledge intensive and qualifying that way. If you do meet the business in distress qualification, well, you've got some optionality. And what I would just say is the condition A and condition B, effectively, what we're looking at is complying with the specific rules for those conditions at the point the investment is made, and obviously all of the standard EIS rules for the 3 years afterwards. But it's conceptually simpler to qualify because you only really need to worry about the point at which the investment is made. Whereas if you think about knowledge intensive, and particularly the skilled employees condition, that's a condition that must be met for the whole 3 years after the investment is made. And so with KI, there's always a risk here. You know, things happen. You may, have some bad cash flow. You may need to make most of your team redundant. The risk is if you do that within the 3-year holding period after the investors have invested, and you drop below the requisite number of employees with master's degrees, well, then you're not going to qualify for KI anymore, and investors may have their relief voided. So knowledge intensive is riskier in terms of long-term compliance, but it may be that if you fall into the business in distress issue, that it's the only one that you're eligible for. So, I mean, I think the point is probably think about it, get legal advice on it, and crucially, make sure you do an advance assurance before the round that you're going to rely on condition A, condition B, or knowledge intensive, because what you don't want to do is be outside the 7-year period, take investment, and then have to run it past HMRC and try to persuade them that you fall into one of these extensions. So yeah, get that advance assurance done and make sure that you've got legal advice on which is the most appropriate route. So we'll take questions in a sec. Before we do, just a flag for our event, which is coming up in August on the 17th. So all of the sessions so far have really looked at this from the startups perspective. So really thinking about it from the company, what do we need to do to qualify for these schemes? The next scheme is looking at it from the other side of the table. So it's looking at it from the perspective of investors. And we're going to cover a couple of things. So number one, a recap on all the tax reliefs that are available to investors under EIS. We're then going to have a look at the investor requirements. So you'll know if you've done the previous presentations, or perhaps just generally know that EIS is not just about the company meeting requirements, it's also about investors themselves being eligible and meeting requirements. So we'll have a look at some of those investor conditions. The third thing we'll have a look at is just a bit of a think about the kind of documentation that you should be asking startups for if you are making investments under EIS, and specifically actually with a bit of a focus on the documents you would ask for if the startup's qualifying under condition A, condition B, or knowledge intensive. And then finally, as a sort of final recap and a final way of closing off the series, we'll talk a little bit about what can go wrong for investors. There's sort of things that we thankfully don't see very often, but that can pop up. And what you can do to avoid those. So Ivan, who's our CEO, is going to run through any questions that we've got. If you do have any questions, pop them in the chat, and we'll be very happy to answer them.
Hi guys, thank you very much for that super insightful presentation. I'm pretty sure that everyone found it really helpful. We do have a couple of questions, and as Michael said, feel free to share your questions in the chat box and we will answer them shortly. And the first question is from Patricia. Are we saying that a business in distress isn't able to raise after 7 years, so that all of these conditions are irrelevant?
So I can take that one. So, I mean, if you are a business in distress and you sort of don't meet the financial health requirement, then you can't raise, your investor, can't claim EIS anyway. You wouldn't be eligible for EIS. So if you were sort of meeting the financial health requirement, but then you were not necessarily meeting the third limb, which we spoke about, which is the accumulated losses being more than 50% of your share capital. The other option would be to see if you could be a knowledge intensive company, because if you meet the first two limbs, so you can pay your debts as they fall due, and the value of your assets does exceed the value of your liabilities, then you would still be eligible to claim as a knowledge intensive company between that 7 and 10 years. So after 7 years, that's the only sort of way you could do it in that scenario. But if you are a business in distress and you don't meet the financial health requirement at all, then you wouldn't be able to claim EIS at all.
Perfect. Thank you so much, Ellie. Next question is from Anna. How carefully do HMRC look at the new geographical market requirements? Can I just move my manufacturing to the market and qualify?
I can take that one. So it's not so much really about HMRC looking at it. It's more about you have to give HMRC the information that they require in order for you to qualify for condition B and demonstrate you're going to enter a new geographical market. So, you know, as we said, you need to demonstrate that this is a material, significant step and not just an incremental change. So you need to be demonstrating to HMRC that, you know, this is a market you've not been active in before, that you're going to carry out significant activities and spend a load of investment money accessing that market. So merely moving a manufacturing centre from, you know, the UK to your target market isn't going to be sufficient. You're going to need to show significant research and development, marketing costs, all of that kind of thing. It doesn't mean that, you know, manufacturing isn't a part of it. It may well be, and it may well be that you set up a manufacturing centre in your new market, but it's unlikely to be the only thing you're doing if you want to qualify for condition B.
Perfect. Thank you so much, Mike. The next question is from anonymous user. Is research and development defined the same way for the operating cost conditions for knowledge-intensive companies as for R&D tax relief?
I can take this one because I was actually reading about this today. So very, very similar in terms of definition of, you know, research and development, but in terms of operating costs and the operating cost condition, when you're calculating qualifying expenditure, there is a way that you can do it under EIS, and there's a way that you can do it for sort of R&D tax credits. And HMRC's manual actually says that you can use either or. So they are different, they're not the same, but you can use either or. So I mean, it's not my specialty and it will probably be your accountants looking at it, but yeah, you could use either or. So they are slightly different, but very similar.
Perfect. Thank you so much, Ellie. The following question is from Kel. Can you rely on condition A and then change to condition B for your next round?
I can answer this one. This is a nice and simple one. The answer is yes, you can. You can rely on condition A first, and then in the future decide that condition B is for you because you changed your business activity or something like that. If you comply with everything else under the sort of EIS scheme, that would be available to you.
Right, and the only thing to remember is you can then do potentially condition A again, maybe in respect of the condition B bit. What you can't do is once you've raised money to enter, for example, a new geographical market, you can't raise money under condition B for that same market, but you could raise money on condition B for a different market. So you could raise it first to enter the US, and then you could raise it again under condition B to enter China, say. So yeah, there's flexibility to jump between the two.
Perfect. Thank you so much, guys. I'm just going to take final 3 questions. I can see that we've got quite a few, but I'm going to choose final 3. And the next question is from Mihai. My business has acquired another business with an earlier commencement of trade date, which means I'm outside the 7 years period. Can I rely on condition A and B to continue to raise money?
The answer is yes, you can, as long as the conditions for it and the EIS conditions are met. So I suspect, well, the issue you've got is, by the sounds of it, that you've acquired a business that has got an earlier commencement of trade date. That date's been imputed to your business and pushed you outside your 7-year period. So there's a couple of ways of potentially doing it. If you acquired the business through a qualifying share-for-share exchange, and that business that you acquired had contemplated follow-on funding when it had applied for EIS previously, then it sort of contemplation of follow-on funding follows through to your business, and you can then apply under condition A on the basis of that follow-on funding. Of course, equally, if you had raised money previously and contemplated follow-on funding, then you could do it under your own condition A as well. With respect to condition B, if your business is entering the new geographical market and you previously raised EIS or under a venture capital scheme, then yes, you could raise under condition B. So the fact you've acquired a business shouldn't be preventing you from using these conditions. The only point I would just make is before you acquire a business, make sure you do get legal advice on the EIS, because there are some problems that arise from acquiring a business. So for example, if you just buy out the share capital and you just do it as a standard, say, cash sale, what you'll find generally is that the business you acquire is non-qualifying for the purposes of EIS. So you won't be able to spend the EIS money that you raise funding that acquired business. So there's a bit of technicality around it, and talk to a lawyer before you do it. But yeah, in principle, in respect to the narrow point, it should be fine.
Perfect. Thank you so much, Mike. The next question is from Mustafa. And he's asking a question for startups. What if more than 50% capital previous investment was consumed during an year, but the operation was delayed due to a genuine reason?
So the business in distress rule, or it is a sort of a strict requirement. So as far as I'm aware, HMRC don't give you sort of scope to argue that this has happened because of COVID or because of a sort of a reason beyond your control. As far as I'm aware, it's a strict requirement. So if you are outside the 7-year period and you've spent more than 50% of your share capital, then that's it. What I would say though is there are some creative ways potentially you can get around it. So just as an example, you can build up your share capital by raising money from non-EIS investors. So what you could do is go out to market and you can raise money from US investors or corporates or institutional investors who don't care about EIS. That will bolster your share premium account, meaning that then when you come to raise an EIS round, you won't have spent more than 50% of your share capital. So it's measured at the point you raise the EIS round, not previously. So it's a snapshot in time.
Perfect. Thank you so much, Mike. And thank you for the question, Mustafa. And the final question is from Mihai. From Val. I'm an investor. If I invest in a knowledge-intensive company, how do I know that it meets the conditions?
I'll take that one. So interesting question, because we're actually, as I mentioned, our last webinar is from an investor's perspective. So definitely come along on the 17th of August to listen. We'll go into it in a lot more depth, but ultimately the short answer is that you will want the company to have done an advanced assurance application. So they'll have sent an application to HMRC, all the details about their company, and then they'll get a response from HMRC. That response will say basically, yes, we are giving you advanced assurance that you are a knowledge-intensive qualifying company, or they won't. And so what you want from the company is that response. Now, that response is quite a standard response. When you get one from HMRC, it's sort of an email. So very crucially, you want to be looking for the explicit words that it is knowledge intensive, because ordinarily they will sort of look the same, but there is that slight difference. So that's what you would want basically. But yeah, we're going to look at that in a little bit more detail in our next webinar. So. And
I guess the point just for startups on that, Ellie's absolutely right. The letter that HMRC send is entirely standard, and very, very often they forget to confirm in that letter that the company is being authorised for knowledge intensive. So frequently, I would say actually 90% of the time, we get a letter back from HMRC saying standard stuff. On the basis of the information you provided, we believe we'll be able to issue compliance statements to investors in the round. If they've said that, you do need to push back to HMRC and say, thanks very much, but can you confirm it's knowledge intensive? Just because they do forget doing it. So always make sure that you check that one.
Perfect. Thank you so much for your time, guys. And thank you so much for the presentation. I'm sure that everyone found it really useful and insightful. If you have any questions, feel free to shoot an email to Michael and Telly. Their contact details are on the website, or you can always call our main reception desk and we can always set up a Zoom meeting or a call with them. As Michael said earlier, his book Built on Rock was a bestseller on Amazon. So currently we are running a promotion. You can get a copy of the book for discounted price of £9. The promotion finishes at the end of the month, so make sure that you grab your discounted copy right now. And we are very active on social media. We post lots of posts on LinkedIn, Twitter, Facebook, Instagram, with lots of relevant content on SES, EIS, anything that it's relevant to the startup world. So make sure that you follow us. And as already Mike and Telly mentioned, our next event is on 17th of August on the guidance on EIS for investors. Make sure that you grab your ticket because we are running out of tickets. It's a very popular event and we hope to see you at the next event. Thank you and good night.